Okay, we're all set at this time, and let's see if we can have it. Here we go, folks. This is rulings and cases, and what I have traditionally have done, because the rulings in the text and the cases have some bearing, but are not quite as important as what is not in there. And that's not an immodesty on my part, but just as a practitioner, what we see. So I'm going to open up by looking at, as we could go through the first part of the chapter, you see what reasonable basis is versus non-reasonable basis, so forth, substantial authority, types of authority, federal court cases, so forth. Having reasonable basis is having some support based on these areas. And it says here that edit and condense, you read the whole case before relying on it. That's always a good idea. What I have announced, because it's covered nowhere in our seminars, is the areas of enforcement and related issues, latest developments. Now, the reason this is important is because if we know what the areas of enforcement are and related issues, particularly, we can concentrate when we are meeting with our clients as to what is particularly a thorny issue involving their tax planning, involving their tax returns. These are some of the general hot compliance targets of the IRS. Offshore banking. The Internal Revenue Service has revved it up. There are two cases in our rulings and case chapter, which one specifies that the FABAR penalty is applied per farm and not general. Secondly, the case essentially says there is a zero tolerance in terms of the penalty. There's virtually no reasonable cause. The other one continues to be the IRS self-employment tax avoidance and issues. This resulted from a TIGTA report, Treasury Inspector General for Tax Administration a number of years ago, who said the IRS was missing billions in terms of self-employment tax. That's why when a 1099 NEC is issued, previously a 1099 miscellaneous with non-employee compensation, when that was issued, these are being reconciled to the returns and notices sent out by the Service Center. Cryptocurrencies, and I'll cover that in a minute, conservation easement syndications. This is considered a form of a very abusive shelter. Now, if you do have a conservation easement, where you go is to the Internal Revenue Service website, and there is an audit guide regarding the conservation easements. You follow this audit guide, and it will tell you exactly what to submit. I know practitioners that followed it, they never had a problem. But getting involved in these conservation easement syndications, which are essentially promising you something for nothing, you got a problem. And the IRS has announced an increased audits of tax-exempt entities. Fake charities, tax-related schemes, a reminder that GoFundMe accounts do not qualify as deduction for charitable contributions. And of course, we have the senior immigrant fraud, which is, again, the phone calls that are being now they're targeting seniors and immigrants in these particular situations. The IRS also is looking at offers and compromise mills, charging excessive fees and making promises that have little chance of success. These are probably one of the greatest scams ever. Particularly some nights I'm up working late like you, a lot of nights, might have a television on and hear these ads come on. It is only about 3 to 5% of the offers and compromise, ladies and gentlemen, actually clear the appeals division. So these mills will charge a client $5,000 to $10,000, file the necessary forms and say, whoop, can't do it, didn't get it, no refund. Unscrupulous tax return preparers, these include ghost preparers, which we will talk about shortly, and preparers that charge a fee based upon size of refund, promising a big refund, require payments in cash, and will not provide a receipt, invent income to qualify for tax credits, and so forth. Ghost preparers also include individuals who do not sign the return, have the client sign the return. So in this particular situation, we have it where, close the door, okay, and where we have the situation coming where ghost preparers are doing that. So we have really a point to make that ghost preparers are tax returns are self-prepared are more likely to be audited between corporations and partnerships and the IRS. Anyway, let's move on. Lost my bearing here a moment. I apologize. Assisting individuals in unemployment fraud. This is something that amazes me. The fact that unemployment did not vet it. I just wrote a letter on someone who died in 2006. That was someone was claiming unemployment in their name. These pandemic letters that are coming out from the state of Ohio telling individuals in the last 3 weeks that pandemic benefits are ending is a good example of where these frauds are coming out, because they're actually going out to the true individual and the true address. Virtual currencies. This is an issue that's radioactive. Participation in virtual currencies is a prime target of IRS enforcement. Now, the Commissioner of the Internal Revenue Service has asked Congress for the authority to collect information on the cryptocurrency transfers valued at over $10,000. In the Infrastructure Act that was just passed and signed by the President, new information returns have to be issued now for any cryptocurrency transactions. That is part of that Infrastructure Act. So if a client gets involved in virtual currencies, they're marked. They're very much on a list, and the IRS is very serious about this. If you have a client that's engaged in these, have them sign a representation letter. That can be part of your engagement letter, that they've disclosed all information to you. It's been my experience that individuals involved in virtual currencies have been a little shy on telling you the complete truth, but that's just my experience. So we'll have polling question number 1, if we may, please. During this past tax season, I observed that my clients were more engaged in virtual currencies, not engaged in virtual currencies, reluctant to tell me they were involved in virtual currencies, 1 and 2 above. And these virtual currencies, as I said, this is a radioactive transaction on the tax return. This will mark your client. And the IRS is very serious about it. There are 14 separate taxable transactions that can happen with virtual currency. And the IRS, with diminished resources, is actually training individuals in the small business section of the audit function in the examination of these. This is not an area that you're going to see a lot in. So I think we can end the poll. All right, share results. And there we go. Not engaged in virtual currencies. At least they have told you they're not engaged. But here again, this should be part of your engagement letter and your representation letter to where they sign off that indeed they're not engaged in this type of a transaction. So the IRS has stated that in 2020, they made $16 billion in incorrect earned income credit refunds, 24% improper payment rate, $4.5 billion in incorrect child credit refunds, 7.2 in 2019, and 2.3 billion in incorrect opportunity credit refunds. I can say this, you will not hear me defend the IRS service centers much. There's not much to defend. But in this area, the IRS is correct. They have for years have devoted an enormous amount of resources to the monitoring of the earned income credit. Now the child tax credit, with the expansion of it, that fraud is certainly going to increase substantially. And this is as far as the IRS can detect the fraudulent part of it. The IRS currently audits by correspondence approximately 300,000 returns claiming the earned income tax credit. That's probably about half that should be done, but they don't have the resources. 40% of the errors pertain to whether an individual is a qualifying child. Again, due to the changes made to the earned income credit, one can expect more audits. The premium tax credit, the IRS is currently identifying and pursuing taxpayers who have claimed a premium tax credit under the Affordable Care Act. We're particularly looking at 2019. This is the year that this is being directed toward. Returns who claiming the credit and error are identified based on their modified adjusted gross income that is above the threshold to claim the credit. And taxpayers obtained the credit but did not file a return are being targeted. As you know, anyone who claims the advanced premium tax credit has to file a tax return regardless of the other qualifications. This is a favorite, and we're going to be talking about this when we have the webinar section on new legislation. The IRS is currently using data generated by the Form 1099-K, which is a darling to them, to identify taxpayers that should be audited. This is going to be a massive expansion of the number of recipients that is going to happen in the future, to where a 1099-K will be issued for amounts over $600 to anyone that engages that is paid through a third-party processor, PayPal, credit cards, whatever. Now, hold that thought until we have the new legislation chapter, and we'll give you the particulars on that. So let's look at polling question number 2 for my section here. In the past 2 years, I have been contacted, and this is polling question 13, by a client regarding an IRS notice that proposes an adjustment and/or disallowance of premium tax credit, matches Form 1099-K to a client's reported income, both 1 and 2 above, none of the above. I've said earlier in our presentation, if the IRS ever gets anywhere near to any kind of strength again, there's going to be a lot of these audits done, a lot of these issues raised. They have the audit programs in place. They know what needs to be done. They just don't simply have the resources. So let's go here. I think we're getting about all we can.
All right, John, I'm going to end this poll.
Yep, let's end the poll. Okay. So proposes an adjustment and our disallowance, 22%. 6% had 1099-Ks, 13% had 1 and 2. The 59% had none of the above. You should be very fortunate. There will be a substantial expansion in the future involving 1099-Ks. And we're going to see that in terms of the audit. Okay. All right. Self-employment taxes, and I said again, the IRS is continuing to match returns with self-employment income due to a lack of self-employment tax being reported. That majority of these matches result in a letter sent to the taxpayer inquiring as to the lack of self-employment tax, seeking payment of it. It is especially going out to individuals that have filed an application or haven't, not they're targeted because of the application, but that the practitioner, the client, has to produce an application for exemption from Social Security and Medicare taxes, Form 4029, that is signed by the Internal Revenue Service. So you have any clients who have this exemption, be sure that you get a copy of their filed and approved 4029 and keep it in their permanent file. There's been a rise in instances where employees of sole proprietorships and partnerships have their claim to be exempt from Social Security challenged. This is amazing that this is happening, but it shows a general non-compliance. And a reminder that corporations and S corporations are required to have Social Security withheld and match on employees that are all otherwise legally exempt under Form 29 because of the Miller decision, which requires that for corporations. Now, the IRS's large business and international division has a continued audit, and this is what they call campaign. I think that's interesting, like a military campaign. identifying and auditing limited partners and members in an LLC professional service firm claiming exemption from self-employment tax. Now, this was a result of a Indianapolis, Indiana court case in 2017, where 3 attorneys claimed only 1% as active partners, the rest as passive partners, limited partners, and therefore paid self-employment tax only on the 1% instead of the 33 1/3 they owed. And the court said you cannot be both a limited and a active partner in professional service instances. So anyway, you will see that, as we talked about before, I'm not going in this again. We talked about this earlier today. So I'm going to breeze through these slides. We've already covered this. I've covered it a second time. Once is not enough. And I believe that we will have another polling question. Julie, polling question 3. Is this included in there? Polling question 14. The limited liability company structure will generally protect the members of the LLC, will generally not protect a member from an IRS enforcement, can be used effectively by a member raising a defense, none of the above. And I think that this is something, the limited liability company is so misunderstood. The federal government has the ability, for federal law trumping state law, to effectively, in the Internal Revenue Code, supplant the limited liability company when it comes to the owing of taxes. So I think we can end the poll right now. We generally have everyone here. And the results are, will generally not protect a member from an Internal Revenue Enforcement action. And that is correct in that situation. The client, and again, I said, should be thoroughly consulted. We talked about it earlier today. I cannot emphasize this enough. This is a red hot issue. So let's move on and let's go look then at undisclosed foreign bank accounts. Now, the IRS and Department of Justice are renewing and devoting increased resources to the detection of unreported bank accounts with the, and note the word aggregate, that is the total value in excess of $10,000. These also include foreign security accounts and so forth. If a report is required, if the aggregate value, meaning all the client's accounts that are foreign, exceeds 20,000 at any time during the year, the IRS and Justice Department are seeking court orders with foreign banks to obtain this information, and they are merciless in the application of the failure to file report. So let's give, and we want to get these polling questions out of the way. Regarding foreign bank accounts, I inquire as to their existence with my clients by interviewing them, an engagement letter, tax preparation packet, both 1 and 2 above. I do not inquire about the existence of foreign bank accounts. This is a red hot issue. And the courts to date have given no mercy to the taxpayers on the abatement of the penalties, have not seen a reasonable cause basis for not filing the FABAR reports. When in doubt, do it. When in doubt, include a greater amount. In other words, this is a case where you have to be more proactive than not. So regarding this question, we can end the poll. And we have clients that say 54% by both 1 and 2 above. 9% say you do not inquire about that. I hope that you have specific reasons for that, because you should inquire in that. And I would say that one of the big issues with that is making sure there's an engagement letter and tax preparation packet notation of some sort in terms of attempting to analyze where these accounts came from. large partnerships. Now, the IRS is putting together, again, their resources are limited, but they're using a specialized group of agents and specialists in partnership issues to expand the audit of large partnerships. Now, large partnerships are defined by IRS standards as having $10 million or more in assets. So essentially, these are groups of agents that would have worked the larger corporations at one time. The returns are being selected for audit by the use of data analytics that is going into this, but the basic criteria for a large partnership is $10 million or more in assets. The IRS has updated the audit guide involving small retail businesses as to what the examiner should be concerned about. These audit guides are really good, and they're really being written on a very practical level, very readable, if I can use that term. And they give an example of what's going to be handled in a particular audit. And that can be used by the practitioner to address the issue with the client. Now, this audit guide, which has been updated, is now directing the examiners to new gig type businesses, such as food trucks. And two major issues that the audit guide is alerting the examiner, who is determination of whether unreported income exists and whether the cost of goods sold are correct. Having good records, particularly with these food trucks, and this is a new area, it's coming about in the last 5 years, is very important, and to consult the client on this. They have other potential issues that are discussed. IRS is still receiving, or did receive, the 2017 year now for the large part has expired, but they still have an inventory of amended returns for pre-2018 years, claiming now eliminated domestic production deduction. These claims, which are bogus, are resulting in several $1 billion. So any type of these amended returns claiming this deduction are a focus of current audits. As you know, the statute of limitation is extended on a claim or amended return by 2 years from the date of the amended return claim. With passports and delinquent taxes, the IRS is enforcing the legal requirement that when a taxpayer owes $54,000 or more in delinquent taxes, they can be denied a passport or have their current one revoked. They are accomplishing this by notifying the State Department of who these individuals are and advising them by letter that their name was submitted to the State Department regarding the enforcement of this provision. So a taxpayer will get a letter saying that the IRS has got its act together and is working with the State Department on this. It does not apply to individuals, however, who have installment agreements, live in a federally declared disaster area, or in bankruptcy, or were determined by the IRS that the debt cannot be collected due to hardship. In prior audits, we have discussed the absolute need to obtain a professional and desirably certified valuation of property that is inherited, part of a basket purchase, etc. Now, the IRS is now using, there is a case, a county auditor assessor's valuation to challenge the lack of these formal valuations. That actually is an improvement, because prior to this, the IRS is saying in many cases where you do not have a certified valuation, they're allowing no basis for that property that is based upon a fair market value. So the certified valuation is critical. If you don't have it, you can fall back on the auditor assessor's valuation. But you do need a valuation of some sort when you're doing with equipment, for example, that is inherited, because this equipment is subject, when it's inherited again, to a stepped up basis and is subject to depreciation again. So we can see that the problem with the county auditor's valuation is they're not often correct for property tax purposes, but basically some valuation is better than none. As we discussed last year, a shocking report, this still shocks me and still upsets me about the IRS, was issued that stated the IRS was not pursuing high income taxpayers who were not filing their tax return. Now the IRS, because they were burned by the Treasury Inspector General's for Tax Administration Office in a critical report of this, is currently pursuing such individuals to obtain their delinquent tax returns. However, I've heard of cases where these delinquent tax returns are being given to revenue officers who have no technical expertise, who are not looking at them, just simply want the tax return submitted. Well, the IRS needs to improve their act, but this is a case that's going on. So you will see more on-site visits attempting to obtain the tax returns from these delinquent filers, including tax preparers that have not filed. And we will talk about some legislation in the works that is still in the back burner that will have the IRS a lot of more power to strip non-filing tax preparers of any rights to be able to come into a situation where they're doing tax returns. And there is a separate bill that's on the back burner of Congress that is not tied into this budget bill, dealing with the IRS having more authority over tax return preparers. And those of you who obtained back in 2011 your registered tax preparer certification, guess what? It wasn't in vain. As I've said for many years, you're actually come automatically under the qualifications of the new bill. The Office of the Treasury Inspector General of the Tax Administration has said the IRS has failed to vigorously enforce backup withholding rules, saying it's costing billions in lost revenue. Now, the problem with this is in their sample 440,000, they say there was 13.3 billion lost revenue. They said the non-compliance problem was primarily with Forms 1099, reporting non-employee compensation. What this means to us is we can see in the coming months more IRS inquiries, notification, etc., and a much tougher stance on backup withholding, why it wasn't done, why it should be done. Anytime TIGTA criticizes the IRS overreaction is generally to get very tough in this area, or maybe proper reaction, depends, but it does mean more notices will be coming out. So we can find this out. One of the other things TIGTA came across is saying that IRS be ready to plan and take additional actions to identify and enforce the reporting of early distributions taken in 2020 from the retirement accounts taken in accordance with the CARES Act. Now, this means that the IRS will be top of this issue. If many of you remember from past years, the first-time homeowners buyers credit, the IRS followed those credits and those repayments and those reconciliations to tax return for years. I think we can expect this will happen with the early distributions retirement accounts. The problem with these, again, were that many of these were made for reasons other than the COVID reasons, but using COVID excuse. And now individuals will have to pay the taxes on these. And the question is, do they have the money? So the IRS is stepping up the audits of traditional IRAs and Roth IRAs accounts. And Ken's excellent presentation on this is an example of what we're talking about. And listen to Ken. The rules for holding real estate in the IRA are very strict. And I will emphasize to you, the IRS is stepping up audits of these accounts that are holding them. They're taking no prisoners. And I will not go into the list of prohibited transactions, but the same audit focus IRS is having is what Ken just discussed with you in his excellent presentation. Okay. One also can be assured that the leak of certain IRS documents that were published showing alleged abuses by IRAs by wealthy individuals have further invigorated the IRS to examine both the traditional and Roth accounts are meeting all requirements. For example, in the Build Better America proposed tax changes in the budget bill, whatever it's called, there are a number of changes that are made with individual traditional IRAs, individual pension accounts, and Roth IRAs addressed to wealthy individuals, requiring forced distributions, and so forth, if that is ever passed. Okay, so the IRS is continuing to assess account owners for taxes plus penalties from the investment and the holding of master limited partnerships in an IRA. I never knew why these were held in an IRA. What they do, they generate unrelated business income. The owner of the IRA is going to be assessed the taxes on that plus a penalty. And the reason it is doing this is that many of the brokers, not the reason to do it, but many of the brokers sold master limited partnerships, which are highly illiquid because there was a high commission in it. Additionally, the IRS is strictly enforcing that when a taxpayer does not file a Form 8606 reporting non-deductible contributions to an IRA, these contributions are treated as having been deducted and not included in the non-taxable basis of the account. Now, you can argue these, but you're going to have to prove tax returns far past the 6-year period in which the IRS keeps these tax returns on file and that you can obtain one. So this is where the historical records are coming in, but the IRS is saying, prove it to us that you did not claim a contribution and therefore you'll have a basis in the IRA. And as I said, unreported IRA distributions are a major enforcement focus, in particular taxable distributions paid to LLCs, partnership, S corporations, and trust. Now, the IRS is examining these distributions from the viewpoint as to the avoidance of the eventual tax effect. The feeling that an IRA can be left to a trust and that will somehow insulate it from income taxes is foolish. That does not happen. In one case 2 years ago, the IRS followed the IRA distribution, which was to a trust, which was immediately given to 3 charitable beneficiaries, 3 charities, and went after the charities for the tax on that. The IRS is continuing to examine self-employed individuals with self-employed SEP retirement plans. And the major and obvious issue is the taxpayer must have earnings from self-employment to make a contribution to the SEP. The IRS is currently auditing sole proprietorships with a Schedule C who filed a Form 5500. The issues are whether the self-employment deduction was taken on Schedule 1 of Form 1040 rather than adjusted to Schedule C, thus computing the amount of earned income correctly. Notices are coming out simply asking that the income and the computation be reconciled to the notice. Retirement plan audits, the IRS has actually hired some people in the employee pension division. And what they're looking at is the correct filing of Form 5500, resulting in severe penalties for failure to file, violations of reporting and disclosure rules. The head of the IRS employee plan division said that it is their belief that 83% of all these plans have gross deficiencies. They're looking at plan loans that exceed the smaller 50,000 or 50% of account balances. Weather loans for non-residential property are paid back within 5 years. This is a major focus in a retirement plan audit. If someone has borrowed the money for non-residential property, have they paid it back? Loan defaults and how they are treated by the plan. Loan defaults are income. They trigger the closure of the plan and they trigger a massive income. So as I said, the IRS has been hiring employees and training them in the audit function for this. This is an issue a number of practitioners have confided in me is happening to them. The IRS was criticized by the Treasury Inspector General for Tax Administration several years ago that they were not doing enough involving audits of clients' mileage where clients were claiming a deduction based on the mileage. So the IRS is doing this. They're taking a strict approach to the examination of the mileage log. First of all, it must be contemporaneous. It must include odometer readings for each entry, and it must have an explanation. Now, the Internal Revenue Manual has long instructed examiners to verify actual mileage based on odometer readings, but the examiners had leeway and didn't do it. So at very least, the client should provide contemporaneous independent verification of the odometer readings for the beginning and then ending of the year using receipts. And the IRS is taking a very strict approach to these audits and making adjustments accordingly. Now, I will agree with you, it is virtually impossible to get the clients to maintain a log, much less a reliable log. That is a problem. And the IRS will use repair receipts in verification of their examination of entries in the mileage log. The IRS has won several cases that support the stricter examination of the computation of mileage, including one that is in this chapter, which supports the IRS position that you have to have a log and you have to have a good log to do that. Good luck in getting the clients to do this. IRS has stepped up its audits involving taxpayers who engage in transactions in excess of $10,000 or more. Now, these reports are required to be filed when banks accept deposits or cashing third-party checks. What individuals don't realize is that each institution has an internal control mechanism that computes the total cash deposits. So it's not necessarily a per transaction. It could be several transactions within a given time can trigger a cash transaction reports. And it does not mean that a client is safe by doing one for $9,900 and then do one next week for the same amount that can trigger a cash transaction report. The IRS views these as a form of money laundering, and it results in a confiscation of essentially all the money involved in this. That's a quick and dirty way of explaining that to you. I am concerned about this because this is something that should be also involved in your representation letter, engagement letter, that is your client doing this? You want to ask them, even if they lie to you in the engagement representation letter, you at least want to be covered. Now, the emphasis on cash transaction audits results from, again, a TIGTA determination that billions were being avoided. One of the things is prompting this was this nonsense about having an information return from the banks and financial institutions showing gross deposits, gross withdrawals. The latest information is that has been dropped from the Build Better America Act. That's not going anywhere. So one other thing is IRS examiners amazingly have access to a database on their laptop computers they bring out and on that detail if a given taxpayer has been subject to one of these reports. So this is often a tricky question. Is the client had any of these transactions? The IRS may already know that answer. We've discussed this in prior seminars. It's going on again this year. The IRS is focusing on the issue of taxpayers who claim the fuel tax credit for fuel utilized in off-road business purposes, but it's been brought to the forefront by the filing of a amended return seeking large refunds based on this credit. So if you're claiming a large amount for this fuel tax off-road usage, it is a subject of IRS analytics and a focus for a potential audit. And we will see this, that the IRS has built in certain filters in their software to electronically identify suspicious credits. Related party transactions, this is something that is nothing new. It's been going on for years, but the IRS is now, through a series of audit issue advisories and memorandums to their examiners, has instructed them to focus on related party transactions as a component of their audits. Examples of this issue to be examined: related party sales, purchases as to basis, sales price, prohibitive subsequent tax treatment, installment sales, claiming of losses on related party transactions, that's prohibited, imputed interest on transactions, Code Section 7872. And as we've said many times, like with the mileage log, we could say it here, the best thing you can do for the IRS is do nothing. Despite all of their information. You should do this, you should do that. Best thing you can do for them is do nothing, because the courts have said when you do nothing and the burden of proof is on you, the IRS can carve you up like a Thanksgiving turkey. And believe me, they will. Loans and advances to a related entity as to whether they are evidenced by loan agreements, stated interest, payments made, debt versus equity treatments. And as I said, when you get in related party transactions, again, you should be probing these through your engagement letter, through your representation letter, through your audit interview. We don't have a slide on this, but I want to inject this now because this is something that has come to the forefront in the last 3 or 4 weeks. Those of you that have C corporation clients, you want to look at their balance sheet. Where these clients are, for back of another phrase, cash cows, rich in cash, low in debt. You want to look very closely at that and determine whether or not a Section 531 accumulated earnings tax applies to it. Now, this is a very punitive tax determined under something called the Bardot formula, where you have a client, for example, that has 4 million in cash, has virtually no debt. They have a Section 531 issue. Now, things that can be done to abate that issue before the IRS comes in. Contingency plans can be built in. Reasonable needs can be determined in the minute book, so forth, but it has to be done before the IRS comes in. Now, the reason I'm raising this issue is because the tax court suddenly has 3 cases in their jurisdiction on the Section 531 issue, which means the IRS is raising those. Go through your C corporation clients and see if they're cash rich. See if they're subject to this. You have a question, contact me. And please pardon me for digressing here, but Sandra, could you please send me your email address or put it in the chat section? I have your questions, but I don't have any way to answer them or get back to you. Large losses on Schedule C. Again, the Office of Treasury Inspector General for Tax Administration has cited the IRS for not conducting enough audits and returns, claiming Schedule C that have large losses and no gross receipts. This is a no-brainer. I mean, this should stand out like a red flare in a dark night sky. You have that situation. You have a client that is potentially looking at an audit, if not a field audit, certainly a service center audit. And the TIGTA said, properly so, that these returns are somewhat fishy and have the potential for large adjustments and compliance risks. Now, in addition, the Large Business International Enforcement Division, in addition to S corporations and partnerships, have announced in June they have started what is termed a quote Tax Cut and Jobs Act compliance campaign. They are also going to look at how tax returns are prepared in accordance with that Tax Cut and Job Acts. That includes accounting methods, so forth, which Merrill covers and Ken covers in their excellent presentation on construction. They're additionally going to focus again on these syndicated conservation easements and captive insurance companies. Both are highly radioactive issues. S corporation shareholders. IRS is examining S corporation shareholders' returns that contain large losses as to whether they have sufficient basis to claim such losses. Now, one issue in particular is whether the shareholder is a co-borrower or guarantor of a loan which does not qualify to increase their basis, unlike a partnership where it does qualify. One of the big disadvantages of S corporations. The IRS has announced a vigorous enforcement program regarding these. This could have been predicted and frankly is long overdue. The 3 areas of audit enforcement are distributions by an S corporation. Focus is on the failure to report the gain on distributions of appreciated property to shareholders. This is a big issue. For example, in lieu of a cash distribution, a shareholder is given a piece of land that substantially increased in value. Failure to report dividends from accumulated earnings and profits that resulted from a C corporation that converted to an S corporation. This nonsense a few years ago of this rush for C corporations to convert to S corporations, to get the qualified business investment deduction. Again, one of the side effects from that, if you did that, is the accumulated earnings came over to the S corporation, are segregated, and are subject to a taxability as a distribution. Cash or property distributions that exceed the shareholders' basis in the corporation. And my thoughts are, these are hot issues. Now, the existence of the applicability of the built-in gains tax is the second area. We had an excellent section in our workbook several years ago, which told you how to compute this. You want to, if you have a client coming in wanting to get out of the restrictive C corporation status, this is the first thing you want to do if they want to become an S corporation, is compute this built-in gains tax, because in many cases, it will deter it. It'll be too expensive. Basis in the corporation, the client has sufficient basis to claim losses. Since 2018, pardon me, actually should have been earlier, we were required to attach to the client's form a 1040, a computation of the basis to those who are in the following situations: report a loss, disposition of stocks, received a distribution, received a loan repayment from the company. My recommendation is to do it on all S corporate shareholder forms because of IRS data analytics that may or may not recognize this. And the audits and enforcement campaigns are supposed to focus on the shareholder level. Now, how you can do this audit at shareholder level when the underlying issue is the related corporation basis and proving it is beyond me. Now, I do want to say to you also that this program will be certainly examining partnerships as well. As we talked the other day, this is where the Schedule K1 is coming in such a matter. The IRS, before I go on, by the way, the IRS is coming out with a new form, and I believe the form number is 7203, that will be used as part of the tax return to compute this basis, show these distributions, and so forth. So we're going to be at a point where we're going to have a form that will complete it as part of our software, rather than have to do a side basis and attach it. Some software programs, such as mine, require to be attached as a PDF file. The S corporation wage issue has been raised again. This year, Treasury Inspector General for Tax Administration says IRS is not enforcing the low shareholder wages. They cited, in fact, half of the audits IRS examiner didn't even question the amount of compensation paid, even when an S corporation was selected for an audit. Now, there's a reason for this. The reason is the IRS examiner will have to open an employment tax audit 4 quarters, 940. This is a separate audit for which their audit program, and the IRS, believe it or not, is statistically driven, doesn't allow them any type of statistical measurement favorable to their function. They are effectively, in my opinion, discouraged from their supervisors to do this for statistical reasons. However, they can go in right now, as been explained in the various presentations with the qualitative business income deduction. And Section 199A says, wait a minute, they don't have to prove the reasonableness of officer salaries. The criteria for them is very light to say, I think the salaries are too low in comparison to the net income. Therefore, I'm going to adjust the salaries up only for purposes of Section 199A to eliminate that deduction. When they go in to examine it for low shareholder wages, to do it for employment tax purposes, they have to have a much stronger criteria that you can debate. But with the 199A, the qualified business income deduction, they have free rein. All right, okay. Form 706, estate tax returns. I covered this the other day. The IRS is examining the Form 706 estate returns that are filed for purposes of obtaining the portability election. And they're looking at them for completeness and accuracy. They're also denying the portability election carryover in the states that claim the exclusion where the form was not filed. So the little known codicil, as we talked about the other day, is you have to file a Form 706, a state return, completely, even though you're not required to file it, but you have to file it, figure that out, in order to get the portability of the unused exclusion carried over. And remember again, it's not automatic. There is a procedure under Revenue Ruling 2017-34 to elect a portability on excusable election. Now, the revenue procedure allows an estate return to be filed no later than the second anniversary of the decedent's death. And the revenue procedure is available only for those estates that were not required to originally file a Form 706. No kidding. If you had to file it originally, you had to file it originally. Tax exempt entities, and this is something that is coming about. The IRS is actually doing tax exempt entity audits. They're looking very closely at determination of unrelated business income and compliance with anti-netting rules. What this is, for example, you have a country club that has a loss in a restaurant. They cannot net this under the Tax Cut Jobs Act against their investment income. Non-member income of social clubs, evidence of any form of self-dealing and inurement, charities that have private benefit issues, proper use of donor advised funds, which are much larger. And here is something that is a real rampant problem. Tax exempt entities is misclassification of workers. It's a way of cutting budgets and saving money. And I've encountered this issue with some fairly large chapters of national charities. You cannot reclassify the administrative assistant as an independent contractor. He or she is an employee. Abusive charitable remainder trusts, and those are cases that are individuals are trying to use charitable remainder trusts to launder sales or whatever so that no gain has to be reported. Charitable remainder trusts are complex. The rules are complex. They are not for the meek and mild. And promoters who use tax exempt entities to promote various tax plans and shelters. So that's the IRS general compliance. A couple of things that are not in the book with rulings cases. Beginning in 2021, the threshold for requiring that all returns are filed electronically is 100 from the current 250. In 2022, it is 10. That is the federal. The threshold is determined on an aggregate basis and includes all income tax returns, employment tax returns, as well as information returns. This is the new one. The travel per diem rates have been issued from the period of October 1st, 2021 through September 30th, 2022. For purposes of the high-low substantiation method, the per diem rates are $296 per day for travel to any high-cost locality. Travel to any other locality is $200 a day. Meal rate, high cost is $74. Per diem rate for any other locality is $64. Now, the question is, what is a high locality? And that is generally considered 50 miles within that principal city. For example, 50 miles surrounding Cleveland, 50 miles surrounding New York City, and so forth. Fees, estate closing letters. The IRS has been issuing closing letters only when they're requested. Generally, resulting from requirement, a state return has to be filed, even though not required. It was decided to pass on this unused exclusion. The volume request for state closing letters has increased so much that the IRS is imposing a $67 fee for issuing that letter. If you want a closing letter, get a closing letter. This is a valuable document, and they're well worth the fees because they provide a firm legal confidence in closing an existing estate future planning. And I'm not certain that the IRS keeps a database of these letters. And the executor, executrix, or administrator of an estate can obtain for free a transcript of comparable information on it for an estate letter. Yet I think the estate letter, closing letter, is a more conclusive document. So we now into several of these cases, and I'm going to be looking at these here. And I think as I'm running out of time, let me look at the Q and answers and see if there's anything here that I can answer as part of my, does investing in cryptocurrency securities constitute transactions, or do you need to use crypto for payments or receipt? Cryptocurrencies are considered property. Brokers that hold cryptocurrencies are going to have to issue these reports, and the IRS is going to look at cryptocurrency transaction for the gain that is involved in properties. You can send a gift of money to an individual through PayPal. Will these transactions be reported on 1099-K? As I talked about, or I'm going to talk about, I should say, the answer to that question, Teresa, is no. My understanding that Canadian retirement accounts are exempt from this reporting. Am I correct? I don't know what reporting you're referring to. Oh, you're looking at the FABAR reporting. Do you have foreign accounts if you invest in mutual funds? If it's a foreign one, yes. If it's a US based one, no. Canadian retirement accounts, an issue came up. I had actually told Anonymous by an IRS when I did exploring, because I had this situation, that Canadian retirement accounts aren't exempt from FABAR. That was an oral comment. An S corporation client refused to take a paycheck and paid Social Security and Medicare. Can a tax preparer be fined in completing a tax return? Anonymous, the answer is no, but there is a rise in court cases where there are no wages being taken as corporation. You're opening yourself to the IRS if they do that type of employment tax audit corporation of classifying the whole distribution as additional wages subject to Social Security and Medicare, and the courts have generally backed them. And I believe with that, I've done my time here. It's now 4:15 and we're ready for the panel discussion involving questions and answered.
All right, and while we have the panel coming in, I'm going to launch the very last polling question, and this was from Barry. So this will be the last polling question of the day, and it's the professional software I use costs. Is it over 10,000? Choice 2, between 7,500 and 10,000. Choice 3, between 5,000 and 7,500, or choice 4, under 5,000. And I'll keep this up for another 30 seconds. And if Meryl and Ken want to come on in and join us with their,
Yeah,
I'm here.
turn on your cameras if you guys want to. How are we doing on the Q&As there, guys?
I have a couple I answered privately, but I'd like to address them publicly.
Okay.
So one of the questions that came in, they were talking about inherited IRAs and, what were the distribution rules and had they changed? And for spouses, they have not changed. But for non-spouses, one of the things they did change was you used to be able to stretch that payment out over your single life expectancy. That's been eliminated by the Secure Act. And now they're saying that you have to fully distribute all the funds over 10 years. So that's the one thing I just wanted to address. And then the second one talked about the HSA accounts, and it just wanted to know, can both spouses contribute to the same HSA? The answer for that is no. Unfortunately, they each have to have their own separate account, even if they're working for the same employer. And then there was a follow-up question to the distribution for the inherited IRAs. It talked about the filing of the Form 1310. And really the 1310 is only necessary when you're filing for a refund for a deceased person. You're trying to claim that refund for that deceased person. And so if you're not the spouse, the surviving spouse, or you're an executor or an administrator, you'd have to file this form. But even as an executor or administrator, you have to have the court order document that is designated you as such that gets attached to that form when you're filing. So I guess this kind of kicks back to that IRA. If they were the executor or administrator for that IRA or for that estate, they are going to have to get that form, submit it with the form 1310 that says that they were designated as such, and they can claim that any outstanding refund for that deceased person.
All right, thanks, Ken. I'm gonna end this poll and share the results. So looks like most of you are under 5,000 in your software. So we'll give these to Barry when we're done. All right, any other questions from you guys?
I see one. I'm not sure if Ken answered or not, but I could re-answer it. Maybe I'll give a different answer. That's how the IRS works. You know, you call 30 times, you get 28 different answers. So.
Careful,
do you-
Merrill.
Do you foresee any potential changes to tax law that would eliminate or reduce or even indirect the tax-free status of Roth and gross of withdrawals? So there actually has been some discussion and some things that were suggested and may or may not get included in the final bill, but they are talking about eliminating Roths over $10 million or forcing people with Roths that are in excess of $10 million to make required minimum distributions.
Those are
They're
in the
also-
bill, Merrill.
Yep, okay, and they're also looking at, as Ken had said, not totally eliminating the backdoor IRA, but for individuals over, I think it was $450,000, something to that effect. I'm not sure, you know, once things get signed, I don't spend a whole lot of time looking at these bills because in the end, it seems like every 5 minutes, somebody's changing something in there. So once things are signed, we'll see what happens.
I think Merrill and Ken would agree that once a bill is passed, a tax law, it is much easier to change it, the parameters, than get it passed originally. So could that forbear for something in the future? Who knows? Okay,
That's the only question I have that I saw that related
here we
to
have-
the,
can a executor administrator sign a POA for a deceased taxpayer so a taxpayer can follow up on outstanding 2020 refund? In reality, that POA has to be named in the name of the estate on that you cannot have a POA for someone who's deceased. So it would be done
Right.
through the estate and would be tied in with what Ken was saying about the Form 1310.
Right.
Catherine asked a question. This is YouTube. Required minimum distributions, for retirement accounts are back in effect for 2021, correct? But now age 72?
That's correct.
Okay.
But if you started taking them already because you hit the 70 and a half rule, you got to continue. You can't stop
correct.
taking them.
That's correct. Yeah. Other questions, folks?
Do you guys see the question in the Q&A from Katrina Collins? Has that one been addressed?
Pardon me?
There's a one in the Q&A from Katrina Collins. Has that been addressed? On any talk on changing the base amount for MFJ?
Um,
I did address that it's, you know, it's one thing they talk about, but they haven't changed it in years.
Okay. All right. I think that is it, everybody. I think we've wrapped up the day here. We made it through the technical problems and I think we're good to go. We'll have the room open. You can log in by 11:30, but you should see us live with our scrolling slideshow and music about noon, a little after, once we're done testing. So you'll use the same link again on Monday and we'll see you back here then. Have a great weekend, everybody.
Thank you, everyone.
Bye, everybody.
Great job, Ken.
Thanks, John.